Split cores are famous for huge yields and massive risk. But what if there was a way to finally stabilize them? Enter CLSA, Brompton's newest ETF that's flipping the script on split core investing. Fasten your seatbelts, folks. This is going to be a good one. Split cores. They're definitely yield beasts of the Canadian market, loved by income hunters, feared by cautious investors, and often completely misunderstood. And in 2025, Brompton has taken that concept and they've wrapped it into something brand new. The Brompton Split Core Class A Share ETF got a good old ticker, CLSA. It's a single ETF that holds a basket of split core Class A shares, potentially giving investors access to those massive distributions without that single fund risk that comes with just owning one of them. But before we dive into why CLSA could change how investors approach high yield income, we need to understand what split cores actually are and how they pull off those jaw-dropping payouts. A split corporation, well, it's like a little income machine built from blue chip stocks. So think of things like, Royal Bank, Enbridge, BCE, and then they're divided into two share classes: preferred shares, which are lower risk, and the Class A shares. The ones we're interested in, these are the higher risk, but they also are the ones that offer those eye-popping yields. Here's how it works. The fund holds a portfolio of dividend-paying companies. It issues preferred shares that pay a fixed dividend, but have first claim on the assets. Whatever's left over after paying those preferred shareholders, well, that goes to the Class A shares. And because those Class A shares are effectively leveraged on the remaining portfolio, the distributions can easily reach double digits, especially when we have a pretty strong market. Sounds perfect, right? Well, there's a catch. There's always a catch. Split cores come with a very specific rule book. So most split cores will only pay Class A distributions as long as their net asset value, or NAV, stays above a certain threshold. If markets pull back and the NAV falls below that target, distributions can be reduced or suspended to protect capital. We saw that during the pandemic for sure. It's part of their design. The goal is to preserve the value of the preferred shares, which get paid first. So while the yields look incredible, the income can disappear in a downturn faster than you can say monthly distribution cut. And that brings us back to Brompton's new ETF, CLSA.to. Instead of betting on a single split core, this one, it spreads its holdings across a basket of them. That diversification alone provides a layer of protection against suspended payouts. If one split core cuts its distribution, others in the ETF may still be paying, helping to keep the overall income stream, hopefully a lot more stable. On top of that, by holding a variety of Class A shares, CLSA gives investors exposure to a wide range of underlying Canadian blue chip companies, all while maintaining that high yield profile. For that very reason, CLSA could carve out a very interesting niche, especially for hybrid portfolios that blend income and growth. You get exposure to some of the most generous income payers in Canada with an added layer of built-in diversification. And in a world where investors are hunting for yield without wanting to risk it all on one fund, this one, it might be the first real attempt to make split core investing just a little more accessible and, a lot more sustainable. A sub to the channel is a sustainable cache of future content. At its core, CLSA aims to provide investors with a high level of income, along with that potential for capital appreciation, all through exposure to some of, I've already mentioned it, Canada's most recognizable blue chip companies. Because these underlying holdings are already built on dividend payers, the ETF, it does start with a solid foundation for yield. And the diversified exposure smooths out that volatility that individual split cores will often face. What's particularly interesting here is how Brompton structured CLSA to capture both, the upside of the Class A shares and the stability that comes from owning many of them at once. you still get the thrill of those double-digit yields, but with a broader base and less exposure to any single NAV threshold. Without a doubt, it has the potential to serve as a true hybrid option, income-focused, but with real room for growth. I will point out that this ETF, it was launched in March of 2025, so we don't have a very long runway of data to pull from, but we still have some very interesting numbers for sure. Okay, I think we should jump into some fundamentals. So without any further ado, let's do this. We will of course start with that surface data. At the time of recording, their current value is coming in at $12.70 and their NAV $12.48. Those net assets under management, $13.45 million. That is a little low, but they're brand new. That will get bigger. And their average volume, according to Yahoo Financial, is 4,545. Once again, that's also low, but that will get, as this gets more popular, that number will go up as well. When it comes to fees, they have a management fee of 0.60%, and they do not yet have a MER, as they are, once again, a brand new ETF. I have absolutely no complaints about that data. Let's dig a little deeper. We'll turn the page, take a look at their holdings. So their top 7 holdings include, well, they have 14.61% of DFN, that's that Dividend 15 Split Core Class A. They also have 13.90% of LBS, the Life and Bank Split Core. They have 10.64% of FFN, that North American Financial 15 Split Core. And they've got 10.64% of SBC, the Brompton Split Bank Core. They have 9.82%, and one of my favorite split cores, ENS, the E-Split Core, that's the one that holds Enbridge. They have 4.50% of GDV, the Global Dividend Split Core, and they have 3.98% of BK, the Canadian Bank Core. God, I love that one too. Those look well diversified. I have no complaints there. All right, let's dig a little deeper though. I want to see these returns. We'll start with their dividend. Currently, they have a yield of 10.06%. It is a monthly dividend of 11.5 cents per share. I will point out, they do want to try and keep that distribution at about 12%. So they will more than likely recalibrate it higher in the near future. All right, looking at their return on investment, we only have 8 months of data, so this is an 8-month ROI. And that's coming in at 27.64%. Factor in the dividends, total return 35.13%. That, holy banana bread, that's not bad. That's not bad at all. So they're really good numbers for a hybrid ETF. So this is one that would fit very well in one of those hybrid portfolios for sure. So that's the Brompton Split Core Class A share ETF. And I've got to say, this one's fascinating. By bundling together a basket of split core Class A shares, Brompton, well, they have essentially created a smoother, more diversified version of one of Canada's highest yielding income strategies. You still get exposure to that rich stream of dividends from top tier companies, but the built-in layer of risk spreading that makes CLSA far less dependent on any single fund's NAV target. I like that. Now, this doesn't make CLSA risk-free. It's still built on leveraged equity positions, and those same dynamics that make Class A shares so powerful in good times can work against you in the downturns. But that diversification here, it does give a much better chance of riding through market swings without seeing the kind of payout suspension that can rattle individual split cores. If you are a long-term follower of the channel, you know I tend to be leery of split cores in bad markets because of that suspension dynamic. This ETF removes my big objection, and that could be a very good thing. And I have to admit that I think I like this ETF quite a bit, actually. If you are interested in CLSA, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on HYLD. Thank you for watching, and I will see you in the next video.